Let's quickly do a very simple example of a change in estimate. Wales Station. Wales Station is a company on the West Coast that specializes in the manufacturing and sale of tourism souvenirs. The following balance as at 31 December 2013 was obtained: property, plant and equipment 12.1 million. Machinery was purchased on 1 January 2014 at a value or cost price of 1.5 million rand, and that it had an estimated useful life of 5 years and a zero residual value as at that stage. Then only a year later, on 1 January 2015, management re-estimated the useful lifetime to a remaining 5 years. On 1 January, they said that it still have 5 years left, and it has an estimated residual value of 100,000 rand. Management applied the reallocation method to account for the change. Okay, now the reallocation method says, let bygones be bygones. We forget about the past. Where do we start? We start at the carry value of the asset as at the beginning of the current financial year. So that is the first thing that we have to determine. Then, based on the carry value as at the beginning of the current financial year, we are going to apply the new estimates. And then we're going to work out what the depreciation is going to be over the remaining lifetime of the asset. Good, depreciation is included in other expenses. We don't need that and we don't need that. Disclose the change in estimate in the applicable notes to the financial statement for the year ended 31 December in accordance with the requirements of IAS 8. Show all calculations clearly. Good. So we said our first starting point is the carry value as the beginning of 2015. Therefore, we still have to do the calculation. What was the cost price on 1 January? 1.5 million. And what was the depreciation written off up to the beginning of the current financial year? Cost price 1 Jan 2014 was 1.4 million, 1.5 million. The depreciation, no residual value, we're going to depreciate it over 5 years. So therefore, for the full year that we've used the asset, it would have been 1.5 divided by 5, gives us 300,000 rand. So at the end of 2014, or as at 1 January 2015, the carry value as at the beginning of the year, the carry value was 1.2 million rand. Now, if we're going to do the old method, we would have set the cost price 1.5 million, the accumulated depreciation 300,000, so that gave us a carry value as at 1 January of 1.2 million. If we did carry on with the old way, we would have written off another 300,000 rand for this year. It would have given us a carry value at the end of the current financial year of 900,000. There is no estimated residual value under the old estimates. Therefore, under the old method, from the end of the current financial year up to the end of the lifetime of the asset, we would have written off 900,000 rand. Now we're going to apply the reallocation method in order to effect the change in estimate. So where do we start? We start at the carry value as at the beginning of the year, 1.2 million rand. Now we're going to apply the new estimate on the carry value as at the beginning of the year. So we're going to take the 1.2 million, we're going to deduct the estimated residual value under the new estimate now, 100,000, and then we're going to tell each other that we want to write off that depreciable value of 1.1 million over the remaining lifetime of the asset as at 1 January 2014. And here they tell us that the remaining lifetime, useful life, as at 1 January 2015 was 5 years. So that means then by implication that we want to write off that 1.1 million over a 5-year period, which gives us a depreciation charge over the next 5 years of 220,000 rand per annum. So 220,000 is what we're actually going to pass as depreciation in the current financial period. What is the impact on the current financial year? If we did continue with the old way, we would have written off depreciation of 300,000. Now we are only going to write off depreciation of 220,000. So obviously, we're going to write off 80,000 Rand less of depreciation now, and that will be a positive impact on our current year's profits. In the future, as from the end of the financial year, the carrying value at the end of the financial year of this asset is going to be 980,000. We're only going to depreciate it up to the estimated residual value of 100,000. So therefore, in the future, under the new method, we're going to write off 880,000 Rand worth of depreciation. Now, under the new method, we're going to provide for 880,000 Rand of depreciation. Under the old method, we would have written off 900,000 Rand worth of depreciation. So obviously, under the new method, we're going to write off 20,000 Rand less, and that is going to have a positive impact on our profits, future profits, as from the end of the current financial year. They want us to disclose that. So you will start off a proper heading on a one-line item. You're not going to say notes of Whale Station. Whale Station Pty Limited is a line item on its own line. And then we're going to say notes to the financial statements for the year ended 31 December 2015. We need to show comparative figures, 2015 Rand, 2014 Rand. You must put the Rand down as well. Profit before tax note. Profit before tax was calculated after taking the following into account. Depreciation, and now we have to split original estimate and change in estimate. How much depreciation did we write off last year? We wrote off 300,000 Rand worth of depreciation last year, and that was the total amount. If we did continue in the old way, how much would we have written off this year? Again, 300,000 Rand. So our original estimate here, is going to be, I don't know what happened here, just one sec. Our original estimate here is going to be the original 300,000, which we would have written off if we did continue. How much did we in actual fact going to write off? We're going to write off in actual fact only 220,000. So that is our actual depreciation charge for the year. What is the impact then? Well, to make the 300,000 220,000, I have to reduce it with 80,000. And that is that 80,000 that we were talking about. Good. Our change in estimate note. During the current year, there was a change in estimate with regards to depreciation due to a change in the residual value of the asset from 0 to 100,000 and the change in the useful lifetime of the asset from 5 years to 6 years. Remember what they've told us here. They've told us here originally they estimated a lifetime of 5 years. And then in 1 January, it has a remaining lifetime of 5 years. So 1 year gone past, so 5 as from the 1st of January plus the number of years that gone past, which is another year, gives us then a total of 6 years. So the total lifetime of the asset is 6 years estimated to be now. The effect of the current year's profits is the increase of 80,000 Rand, and future profits will increase with 20,000, which is the difference between the 900,000 total depreciation under the old method and 800,000 total future depreciation under the new method. And then we're done.